Good afternoon, everyone, and welcome to our webinar, GASB Update 2021. I'm Janice Kaplan with the Marketing Department here at James Moore & Company, and on behalf of the firm, I'd like to thank you for joining this kickoff of our 2021 Government Summer CPE Series. With me to present today are James Moore partners Zach Shalafor and James Halloran. Zach and James combined for nearly 40 years of audit experience with an emphasis on government work and involvement in your industry. So their extensive knowledge is going to be a perfect fit for what we're covering today. So with all that said, I'll hand things over to Zach and James to get the presentation started. Guys, go ahead.
All right, thank you, Janice, and good afternoon, everyone. Welcome to this year's CPE series. For those of you who were able to join us for sessions last year, welcome back. And for those who missed out on last year, our inaugural CPE series, but are joining us today, welcome. We hope many of you will get to partake in multiple of the 8 webinars that we're doing this year. And hopefully this, about a year ago when we started this last year, at this time, everyone is doing well. I know from a government standpoint, many of the cities, counties, and others that we work with, financially, the picture looks much better than some of us kind of expected or feared a year ago, not knowing really what the future was going to hold from a revenue standpoint and otherwise. So this year, we're going to kick it off just like last year with our GASB update, taking a look at all of the standards that are really upcoming these next few years. We've got a full list here. So as you can see, there's a lot of material to get into. So we're going to jump right into it. Looking at, before we get into the actual standards and when they all go into effect, again, looking back about a year ago, when we were at the very front end of the pandemic, the GASB did, of course, meet on a really emergency basis and discuss the timing on various implementations. So just to help set the stage here, do want to do a quick refresher, and we're going to look at everything based on those revised implementation dates. As you can see here, there were about 9 standards that were impacted. So we're going to look at all of these pending standards based on the current implementation dates. The only item that we're not going to touch on is GASB Statement 83 related to asset retirement obligations. That was kind of a weird one for anyone with a June 30th or September 30th year end. That would have gone into effect for fiscal year 2020. By the time this extension rolled around last year, probably anyone impacted had already implemented it, but technically for anyone that had not yet reported your 2020 that met this criteria, that was extended by 1 year. So technically that implementation would be required for fiscal year 2021 for those June 30th and September 30th year ends. The big ones, of course, that we'll talk about a little bit today will be 84 and 87 related to fiduciary activity and leases. And then at that point in time last year, every other standard that had been issued and was pending future implementation dates, all of those were pushed back by 1 year as well. So looking at the current schedule of what do we have coming up, what's going to have to be implemented in these 2021 fiscal years and beyond. For 2021, the big one, which doesn't impact everyone, more of an impact at the county level and the school district level, and also the higher education side of things as well, is fiduciary activities, basically totally changing the standards for how we account for fiduciary activities. Statement 90 as well, majority equity interest, not as big of an impact. We'll touch on that shortly. The big one, of course, in 2022 is leases, as well as a couple of other standards that will go into effect for next year's financial statements. We've got a trio coming in 2023. And then there's also a few other impacts of some guidance that has been issued, implementation guidance, as well as a technical bulletin that really does have more of an immediate impact. So while some of those were issued last year, we will touch on that briefly as well, because we did not cover that in last year's GASB update. So to talk about GASB Technical Bulletin 2020-1, this was issued again close to a year ago, but since we hadn't covered it in this session, we did want to touch on that. And that was the initial guidance that came out related to various pandemic-related matters, primarily focused on the CARES Act and coronavirus relief fund funding that was out there at this time last year, that we were all starting to kind of see what that would look like. So while it was in effect immediately, did want to do a quick refresher, as I still have seen some questions in recent months about some of these revenues, especially from governments that maybe didn't spend all of those dollars in fiscal year 2020. So the first question in this bulletin was, are these revenues subject to the eligibility requirements or to purpose restrictions, and when should they be recognized as revenue? Again, many of those cash payments went out in advance. So ultimately, if there was cash received but not yet spent in terms of the eligible expense, that would have been an unearned revenue liability until those expenditures were met in terms of matching the revenue to the expense. So basically here it's your normal revenue recognition treatment. So number two, when looking at loss of revenue as an eligibility requirement for purposes of revenue recognition, there were some funds where revenue loss was an eligible use. And in that case, that would be that criteria to recognize the revenue. The CARES Act, CRF, COVID Relief Fund, of course, did not have that provision. Kind of the lifeline there, as we talked about at the end of last year's series, and there was a lot of talk in the fall, was looking at really the change for public safety payroll as an eligible use of those dollars. But again, revenue recognition or revenue loss, excuse me, was not enough to cover a use of those funds under the CRF dollars. But for some funds where that was an allowable use, that did meet the requirement or criteria to recognize that revenue. So question number three looked at amendments to the CARES Act after the financial statement date, and basically said that the impacts of any amendment to the act subsequent to the financial statement date would only be considered in the reporting period. One area of question that we saw about that related to the guidance that came out last fall to say that public safety payroll was an eligible use of those dollars. For anyone still looking potentially at the cutoff, number one, that guidance came out, I believe, before September 30th for those 9/30 year ends. And then additionally, it wasn't a change to the CARES Act, but just kind of an ongoing clarification of the use of those funds. So we had looked at that as still just an extension of the original act and when that was actually issued last, either March or April. And question number four, not so common for most here, but there could be some nonprofits that follow GASB. And for those that received PPP loans, the Paycheck Protection Program, that was one where they said it should be recorded as a liability until forgiven. As many of you have probably heard, all of those PPP loans, there's certain forgiveness criteria. So that's been a very common issue for many entities to say, okay, when do you recognize that as revenue versus a liability, given the expectation in most cases for that to be forgiven. And the practical consideration we had thrown in here is, wouldn't it have been nice if governments could have applied for PPP loans as well to get some of that funding. Again, the good news at this point, at least, is most of the areas of concern on revenue loss and otherwise, for many governments, nowhere near as bad as kind of initially feared. So again, something to consider, but overall a pretty good impact from where we could have been. And then enterprise funds, looking at for anyone that reported CARES Act revenues in an enterprise fund, there was clarification here that they should be recorded as non-operating revenues. And we'll talk a little bit more about the new financial reporting model in terms of some differences in presentation, how that will look like going forward. And then number six, the final question here, talked about the pandemic and should any of those inflows, outflows be considered extraordinary or special items? And the answer here was that no, because the items have to be both unusual and infrequent. And the GASB said that it's reasonable to expect that coronavirus diseases will recur in the foreseeable future. So hopefully nothing ever comes close to this, but if there is anyone looking at the quantitative impact there, the GASB did say that no, that should not be reported as either an extraordinary or as a special item. So with that, I'm going to turn it over to James to take us through what's coming up for this current fiscal year.
All righty, well, thank you, Zach. Good way to start it off here. So I'm going to chat a little bit, starting off with GASB 84. This is the Fiduciary Activities. So there's the statement, and it also, as always, they also issue an implementation guide. So there's some guidance in there as well. As I'll go through a little bit later, even they've issued some additional guidance. But so this is applicable for periods beginning after December 15th, 2019. So basically anything after 12/31/2020. So it'll be these 6/30/2021, 9/30 coming up here, that everyone's going to have to apply it. So what did it do? So it provided criteria for 3 types of activities: fiduciary component units, pension and OPEB arrangements, and then everything else that's considered fiduciary activity. So fiduciary and component units, pension arrangements, assets held by a component unit that meet one of the following criteria. As you can see there, pretty much if it's administered through any type of a trust agreement is what you're looking for there on your pension or OPEB. I knew some people had OPEB money that was just kind of set aside, not inside a trust, so theoretically it could have went and used that money for another purpose. If it's not set inside a trust, then it's not considered for a component unit presentation of an OPEB plan. So there's pension and OPEB arrangements as well. If they don't meet the definition of a component unit, still could be included as a fiduciary activity if the government controls the assets in one of those arrangements. That's important to remember as well. So when you're looking at fiduciary activities, it's the center of control of those assets. You must meet all the following criteria: assets controlled, either held or directed by the government, not derived from a government's own resources. So it can't be revenue you're generating from charges from services to citizens or to other people. Anything like that would not be considered to meet a fiduciary fund criteria. And then the assets have one or more of the following: administered through a trust, could be government is not the beneficiary, dedicated providing benefits in accordance with the benefit terms, and legally protected from the government's creditors. Also, the other criteria to look at that for those assets, do they benefit someone outside the entity? Are you holding money for somebody else? So a situation like when you're collecting property taxes as a tax collector for a county, you're collecting it for the local city. Those aren't your taxes. You're holding on behalf of another city or town. So we're looking at what's some key considerations. As we mentioned before, controlled, held and directed by the government. Always remember your own source revenues cannot be fiduciary activity. And you see some examples there. And then the administrative involvement. That's the other criteria to look at, is how much control do you have over those activities, how they could be spent. So one thing to think about when you're looking at these, you have the 4 fiduciary funds, that could be reported. There's pension, and employee benefit plan trust funds, investment trust funds, private purpose trust funds, and now the new exciting one is the custodial funds, which replaces the term agency fund that we had before. The big change in how the financial statements look is previously for agency funds, you presented a statement of changes in assets and liabilities. Now your custodial funds will have to have additions and deductions, just like a pension trust fund did before. So that's something new that we're all going to have to get used to in those fiduciary fund statements. So what are some common examples and who would be impacted? As we've talked a little bit about here so far. Counties, tax collectors is one we see a lot of agency funds with them. School boards as well, internal accounts. You have a lot of internal accounts being the, whether it's a music club at a school or sports club or science club, whatever it might be. So you have all those activities running through the school board system. It'll change how those are presented on the financial statements. So what's that practical impact when you're sitting down to present, to prepare your year-end financial statements? You got to make sure you capture all the additions and deletions in the revenue expense accounts, because we may previously just had to report, the changes in those assets or liabilities. So you got to think about, do I need to change how anything's being recorded so we can get that information at year end? Changes in terminology, all fiduciary funds. So you got to remember, you have to change some title headings here and there. And then for liabilities, liabilities are only recorded when an event occurred that compels the government to disperse the fiduciary resources. So it's only at that point in time you're going to record an accounts payable out to a vendor per se, or if an amount's owed to a beneficiary where it's on behalf of somebody else. As always with changes in accounting standards, it's a good time to relook at all your fiduciary funds. Just because you might have had something as an agency fund for, say, the past 10 years, it might be a good time to look at it and say, hey, does this still really meet that definition? So it's always a good time to kind of change those. Also, I would suggest relooking at some of your special revenue funds. We find sometimes as we pick up new cities and counties, we see stuff as a special revenue fund that really doesn't meet that criterion. Sometimes it winds up being a fiduciary fund. So the next slide, we have a example of kind of how those financial statements are going to look. So, right now, the custodial fund column is the biggest change that you would see. You're going to have those additions and deductions. You'll see those sales, for this one, sales tax collections for other governments is kind of in the middle of the page there on the right, where previously that would have been a change in an asset or liability. And then you have the payments, for out to sales tax to other governments. So this is more looking at how a county that's collecting, in this case with sales tax, could also be property tax. You see on the balance sheet side, you'll see the net position. We delineate what's restricted for pensions, what's restricted for post-employment benefits. If you have an investment trust fund, pool participants, and then if you're holding money on behalf of other organizations, that's where it's going to reside. That ending net position is in that last line item. So I think we're ready for our first polling question. Janice,
We
if
are.
you're ready for it.
Yeah, I'm going to go ahead and push it through right now. All right, you should see it on a blue screen. If you don't see a blue box with the polling question, you may need to exit full screen mode to view it if you're in full screen mode. So after last year's sporadic inclusion, what's your take on dad jokes for this year's webinar series? They were great, the more the merrier. I think you used up all the good ones. Dad jokes, missed last year, but I'm all in this year.
Yeah, I'll just leave you with one thought as you're doing this. An accountant is someone who solves problems you didn't even know you had. See, these are the type of good jokes that we had last year.
Well, and James, I think I forgot. What is it? What do you call it when you have a trial balance that does not balance?
Oh, no.
Oh, that's a bad night, Zach. Yeah.
Oh, okay. I'm going to go ahead and close the question, and let's go ahead and take a look at the results. And there you go.
All right, so they were great, more the merrier, 52%. So I think they like the dad jokes, Zach.
All right. Well, it looks like those that missed out last year, they're looking forward to it as well. So I think we got the right audience.
There we go. All right. Well, now we'll move on to GASB Statement 97 in the 457 plans. And if you go switch one more slide there, Zach. So 97 came out, and the reason why it's kind of plugged in here, 97, your accountants are going, wait, we're not going in number order. What's going on? It's because this kind of went and it applies based on different time frames depending on what it's talking about in the standard. So it addresses both 457 plans as well as some fiduciary component unit criteria. So a little background, you had 84 came out, and with I just was kind of going through, and they said, okay, of course they issue a standard, and then they realized maybe that's not exactly what we wanted, or as people start really reading the standard and figuring out how, when you're going to implement it, it's going to affect things, people realized, I don't know if we really like what the standard's doing, and especially when people start realizing what the cost of the standard was going to be, especially related to defined contribution pension plans. That's kind of a big correction that they had to make. Is initially, potentially, you might have had a lot of your defined contribution pension plans at a government be subject and brought in as a pension trust fund, which would have been an enormous cost, to bring that activity on, and then also to go and audit that activity basically from inception of the plan to date to get comfortable with those balances. So they did issue Implementation Guide 2019-2 that talked about the absence of a governing board should be treated the same as if one had been appointed. And this was mainly hitting those defined contribution plans as well. And then also going back to the original comprehensive implementation guide, it said that RRC Internal Revenue Code Section 457 plans should not be applied to benefits provided. So they needed to add some more guidance here to kind of get everyone on the same page and make sure everyone was understanding. So some of these are effective immediately. So the absence of a governing board in determining financial accountability, that applies right now. So as soon as it was issued, 97, it became applicable. And it applies to everything except for potential component units that are defined contribution plans. That was an important distinction that they made, and that's kind of how they were able to lessen the requirements for defined contribution plans as opposed to a defined benefit plan, is they took this one out, and then also the next one, financial burden criteria as well. They said in addressing financial burden criteria, determining if it's a fiduciary component unit, it only applies to defined benefit pension plans. So they did help us out. Whenever you guys say GASB never really helps us and all they do is add more burden to us, they did actually listen and remove some requirements. So the next big thing was, what do we do with all these the 457 plans that people have? In some cases, years ago, you had 457 plans. For the most part, they were just employee money went in those plans. You might have had a defined benefit pension plan, and then you offered a 457, so people could put money, additional money they wanted to, for retirement. Over time, that kind of changed. Some of them became a little bit of a hybrid, where some of them were contributing, where the employer contributed money in addition to the employee. So they finally said, okay, let's just address all these. So they looked at these and they said, okay, how should these be accounted for? If they meet that definition of a pension plan, being the criteria for financial burden, trust fund, all those other criteria, then report them as a pension plan. If they don't, then you report them like any other pension plan. Typically, it would be a defined contribution pension plan, which really all you're required to do at that point for your defined contribution plans is you disclose that you have this plan, you give a brief description of it, and then what the contributions into the plan were for the year. And this standard for 457's plans applied starting June 30th, 2022. So the next standard is majority equity interest. And this is a real short one. It's very specific of what it applies to. So it applies if you have a majority equity interest in another entity, a legally separate organization. And the question was, okay, what do you do if you have that situation? If you meet the criteria for an investment, you report it then under equity method. If the interest does not meet the criteria for an investment, you report it as a component unit. And then if you acquired a component unit, you look to GASB 69 on combinations and disposals to figure out, okay, how do I measure that at the date of acquisition? Now I'm going to turn it back over to Zach, and he's going to go through the standards that are going to be applicable starting in for 2022 year ends.
All right, thank you, James. And since there's not enough excitement for 2021, although those without fiduciary activities, it's another pretty quiet year for many of you at least. 2022 will not be quite so easy for everyone. There's probably very few that will be not impacted by the changes coming next year. But what we want to do is start it off on a good note, because if we've got a lot of work coming up or bad news or anything else like that, let's always start with the good news and what we can celebrate. So GASB 89, this has been out probably about 3 or 4 years now. And what this related to is there was long ago a standard, and before my time when I started doing this, a standard that said for business type activities, when you're working on a construction project, let's say a new utility plant that spans a few years and you're financing that with debt, that you basically would have to reallocate some of the interest expense and capitalize that as part of the asset. In general, it was kind of a pain from a financial reporting standpoint. fixed asset standpoint, CIP, roll forward schedules, and so forth. And a few years ago, the GASB said, for consistency, because this standard only applied for business type activities, the GASB said, we're just going to go ahead and make it consistent by saying we're going to abolish the concept of capitalized interest when looking at your fixed assets. So as I know I've said in prior years, and to anyone I've talked to, basically, the content in terms of our thoughts on this standard is just 2 words: early implement. If you haven't already, there is still 2021 would be an early implementation. But this was kind of a rare gift from the GASB, I felt, where we actually, the results of the new standard were the requirement to actually do less work. Normally, it's, of course, something new that gets added to our plate and just more work to begin with. But ultimately, this is the official go-ahead to no longer have to follow this accounting standard and go through that calculation year in and year out. So if you do have a capitalized interest template, part of your fixed asset work papers every year, consider whether or not you want to just stop doing that this year versus waiting until that is required for 2022. So another easy one, again, kind of easing into it before we talk about the big one, is Statement 92, and that was an omnibus statement. That's when the GASB has a number of different practice issues and kind of rolls it all into one statement because nothing is significant enough to really stand alone, but there's a handful of areas that need to be clarified to prior statements. So we've got a list here of the different areas addressed in terms of some intra-entity transfers when there's benefit plans between a primary government and a component unit, when to classify those as contributions. A few clarifications to the pension and then fiduciary activity standards, also related to post-employment benefit arrangements. And then looking at acquisition value with regard to asset retirement obligations, there were some clarifications there as well. Again, that will not apply to the vast majority. One item of note where we had seen some inconsistency over the years and kind of the treatment was clarified is it's pretty common for to have insurance coverage where you basically will have a claims expense of some sort or just an actual expense based on what took place, and then there's insurance reimbursement received from just the regular insurance coverage or those that are self-insured as part of your excess coverage. And what the GASB in this clarified is said that amounts that are recoverable or received related to those claims. So if you have a $50,000 claim and you receive $40,000 back from the insurance company, that's not necessarily a $50,000 expense and a $40,000 revenue. Basically, the GASB said those can be reported as reductions to those expenses to kind of net it, or everything be grossed up, but that there's no requirement to which approach should be done. The only other kind of general reminder there I'd put is when you do have future insurance recoveries expected, that those should be generally assessed on an annual basis to say, okay, if we paid out money for a claim but not yet received reimbursement, do we expect to receive reimbursement after year end? And even if not received, that recoverable portion of that claim in theory should be recorded then as a receivable and then treat it whichever way on the income statement. There was also a look at some fair value measurement clarifications, and then a terminology clarification in terms of derivatives to add the word instruments in language where derivatives are discussed in the standards. So the other one going into effect for 2022, again, a very simple standard in the grand scheme of things, is there's various areas where the London interbank offering rate, or LIBOR, as it was defined, was referenced, and with LIBOR going away, the question became of, okay, how do we now, what do we use for those index rates? And effectively what happened here is it was identified to say a secured overnight financing rate and the effective federal funds rate would be appropriate rates to use in those scenarios where a LIBOR kind of market rate would have to be assessed. So again, basically a clarification to kind of talk about that general benchmark interest rate in more general terms rather than that specific reference due to that index going away in the coming months. So the big one, of course, now that we'll get to it, is GASB 87. Already on everyone's radar, I'm sure. I've been having more discussions with clients and otherwise to start talking about what will the impact of it truly look like, because again, this goes into effect for the 2020 fiscal year, but for that reporting period, this will be a retrospective implementation where there will be a restatement required as of October 1st, 2021. So in terms of having to do that initial measurement on the leases, not that it won't be done as part of the ongoing implementation, but it's pretty much time to start kind of inventorying what those leases are to be able to come up with that calculation. So today we're only going to hit it at a very high level. We do have one of our webinars that will take a deep dive, but to kind of hit the Cliff Notes version, let's call it, of the lease standard, what we want to do is a quick overview and identify that really the overall purpose of it. Of course, it totally changes the way that we account for leases. The old criteria for a capital lease and capital versus operating is kind of totally blown out of the water with this whole new concept of looking at leases in one really comprehensive manner. One highlight that we do like to point out, and normally with my FASB friends and others in our firm that don't even touch governmental auditing, nor do they want to. They always talk about how GASB is just so different. I like to point out to them that the FASB standard, there's two types of leases, finance and operating leases. Under the GASB standard, there's no differentiation. There's just the one type of lease. So if you're ever talking to those in the FASB world, trying to recruit to your organization, and you want to downplay that, hey, government, it's different, but it's not always more complicated or otherwise. That's definitely a sales point that I've used internally with some others that don't work on the government side when I'm trying to recruit them to our side of the accounting world. So as far as the scope and the approach, first, the lease is defined to basically say that there's an underlying asset that's non-financial, and there's a right of use for that asset in a contract for a specified period of time, and it's an exchange or an exchange-like transaction. So first, for the control or the right to use the asset, basically you would be obtaining the present service capacity and then also have the ability to determine how that asset is going to be used. So again, that's really the control side of it, to say that, well, it's not just that you can use it, but you have control to dictate how that asset is being used. For an exemption standpoint, the GASB did say that any leases with a term, which is really the maximum possible term, we'll talk about that a little bit more, but if it's equal to or less than a 12-month or 1-year lease, that is scoped out of GASB 87, regardless, again, because there are no renewal options, that doesn't even have to be considered. So first, to simplify the lease liability, again, I kind of like to simplify things like with their early implementation, say, hey, here's a couple pictures of what to really remember. So there is a lot that ultimately goes into this standard, but what I kind of always come back to is conceptually, it still kind of makes sense to say what goes into this lease liability. Again, it's different because we have to look at renewals and the expectation of exercising options, but ultimately what it factors in is to say, okay, step one, let's look at the crystal ball and say, over the course of this agreement, what are the outflows of cash payments going to be for the right to use this asset? Do we expect to go beyond the 5-year term? And then what will those renewal amounts look like? And then, like any other long-term item, once you know what those cash flows look like, then it's just a matter of discounting that to the present value to determine that liability. Again, very simple here. It gets much more complicated, but from a purely theoretical standpoint, that same general theory does apply to this standard like many other long-term liabilities or receivables. We've got a quick summary here of what the initial reporting looks like at the time a lease is entered into. And so first, for the lessee side, there is an intangible asset, which basically equals the lease liability as calculated based on going through that present value analysis. And it also adds in any prepayments or other direct costs that are basically required to put that asset initially into use. On the lessor side, there's a lease receivable, which is basically that same calculation as the lease liability. But the lessor also still records the underlying asset. So if there's $1 million asset being leased, you've still got the $1 million asset plus that lease receivable. And then everybody's favorite, we all love deferred outflows and deferred inflows. On the lessor side, there would be a deferred inflow to basically offset that lease receivable that's used to then amortize that over the period of those lease payments being received. From an ongoing standpoint, that intangible asset gets amortized over the useful life or term of that lease arrangement, and then the liability, likewise, you've discounted your payment schedule, so that's basically reduced more or less just like any other long-term debt or capital lease would be slowly written off from a long-term liability standpoint as those payments are made. On the lessor side, the asset itself still gets depreciated like it would normally, and the lease receivable gets reduced by those lease payments, again, just like any other note receivable where you would have that payment schedule and reduce the principal, record the interest income over the life of that lease. And then that deferred inflow, again, is recognized over the lease term on what's called a systematic and rational manner. I say straight line, there's no prohibition, so a lot of cases that works, or the effective interest method also at times could be used. So a few quick accounting considerations. In that initial discounting, you would look at really what the incremental borrowing rate is if there's not a rate specified in the lease arrangement. One clarification from the GASB is that once you set this lease up, again, if you're using that incremental borrowing rate and that rate changes over time, just with market fluctuations and otherwise, the leases do not have to be remeasured solely due to a change in that incremental borrowing rate. It's kind of you establish it once, then set it and forget it over the life of that lease. From an ongoing standpoint, the amortization of that discount, just like any other long-term item where you've got a discount there, would be recorded as interest expense. And then payments first go towards interest expense, the accrued interest, and then reducing the lease liability, again, just like you would see currently on any capital lease. And the lease asset, just like if you owned the asset, that generally would be a straight line amortization, would be the easiest approach there, to be systematic and rational. And then the term of that asset would be the asset life or lease liability. Generally, I would expect that the lease liability would be the shorter, because it's probably going to be pretty rare that you see a lease agreement for a longer period than the asset's actually expected to last. So a few other looks at it. First, from the governmental fund standpoint. And this is basically going to be different terminology, but same as we're used to doing when you do have a new lease in a governmental fund. Just like currently, if you have a capital lease, you would have an other financing source related to that right of use lease, and then you would have that capital expenditure for the right to use asset that's being recorded on the financial statements. Materiality, there's no guidance set forth to say here's a threshold or really what's a de minimis lease. From our standpoint, if you've got a $500 a month copier lease, there's a good chance that's not going to be material to the financial statements. So we've started talking to some folks about is to say, well, what kind of policy would make sense to say here's a kind of like a capitalization policy, but really a lease recognition policy that maybe looks at the annual payments and the payments over the life of the lease to basically determine what's material to the financial statements, and kind of have a black and white cutoff to really spend time on the leases that count and not getting into the minutia to record some of these leases that are pretty easily could be considered de minimis. And a few other areas to look at is, in any other debt agreements, looking at some of those covenants to say, okay, are any of those adversely impacted by this standard? Does that language need to be reassessed? On lease policies, I mentioned that kind of the capitalization or recognition threshold. There could be a few other areas to look at in terms of trying to get some consistency over what's considered reasonably certain with regard to extension options. And as far as implementing the standard, really the first starting points is to really, I think, just start saying, okay, what are all the leases? Kind of inventory the agreements conceptually, start looking at, okay, what's the annual payment on this lease? How many years does it go out there for? And then from there, it can kind of start saying, well, what does the picture look like in terms of implementing GASB 87? A few starting points, other than just those known leases, is looking at your operating lease note disclosure. Anything currently in there probably is going to fall into the GASB 87 criteria, as well as rent expense, or maybe it's not long term, but there could be something that has those renewal options that would justify recording those potentially as right of use leases. So with that, I do want to just quickly note that we will be, and somehow that the date came off of here, but on June 9th, same time, Wednesday, 2 p.m., in this webinar series, we will take a deep dive focused solely on GASB 84 and 87. So I'm sure there's some questions out there. Hopefully in this webinar, we'll address all of those questions and then some more, really taking a deep dive into those two standards, talking a little bit more about the implementation, what that might look like. So with that, we have polling question number 2. Janice.
That's right, we do. I'm going to go ahead and push that through now. Which of the following accounting pronouncements excites you the most? GASB 87 leases, GASB 85 fiduciary activities, GASB 75 OPEB, or none of the above, and I'm currently rethinking my career. Again, look for the blue box on your screen, minimize your full screen if you can't see it. So we'll wait, give you guys some time to answer. Okay, we got about 91% of y'all, just waiting on a few more. Remember, we need to answer all 3 questions to get your 1.5 credits of CPE. Okay, we're going to go ahead and close out the question. And here are the results. Wow.
Well, Zach, I think maybe after I'm done with my section on the exposure drafts, that number of 48% might be going up a little higher.
That's exactly what I was going to say. We've got about half our holdouts, but once they get the latest rundown, some of those might be shifting down towards the bottom there. And all right, we are back on. All right, so moving to 2023, as I mentioned with the lease standard, we kind of pushed that to the back, not just to save the biggest for last, but also because of how closely it aligns with one of the statements going into effect for 2023. So this one is GASB 96 for subscription-based IT arrangements. Again, becoming more and more common for many of those moving to cloud-based software and otherwise. I know we've dealt with lots of system conversions the last 2 or 3 years. Many governments going from kind of older systems to some of the newer main providers. So the GASB did have a standard to explicitly look at those types of arrangements because again, many of those there's not necessarily a tangible asset like when we talked about leases. So we've got a few terminology here looking at the different key areas of the standard. And the focus here, again, as I said, tying it into leases, it's very similar in terms of there's going to be a future payment schedule established related to the use of that software. And the subscription liability is based on the present value of those future installments. That's generally going to be the same as the asset, where you take that present value of the liability, add any other key payments related to the implementation, and then that becomes your subscription IT asset that you're then going to amortize just like you would any other capital asset or lease. We've got a visual here that again really summarizes the fact that you're capitalizing your implementation costs and then expensing anything pre-implementation or expensing any of the operating costs and only focusing on the implementation side for those capitalizable expenses. Amortization, again, straight line, like with other assets like that. If there's any changes to the terms of that agreement, there would be need for remeasurement. And much like on the lease side, if there's any other incentives, combinations, or different components of a contract, those would have to be assessed individually rather than in the aggregate, because there may be some areas where a certain portion is capitalizable, but something else might be more operating based and not meet the criteria to be capitalized. Note disclosures, much like current capital assets and leases, basically you've got those same requirements for note disclosures, but they will have to be separated for these types of agreements. So disclosing the nature of those, the total asset and accumulated amortization balance, just like you do now for assets under a capital lease. And then the same in terms of the debt side, looking at the 5-year maturity payment schedule and then 5-year increments beyond that. So again, very much what we've already known in terms of assets and liabilities, but it will have to be looked at independently for these subscription-based IT arrangements. So with that, I'll let James cover the rest of 2023.
All righty, conduit debt. All right, no, a lot of our counties have conduit debt that they've issued. So they've issued some standards. Of course, every standard they issue is always to help, eliminate diversity in practice. Is kind of the new terminology they've been using a lot. So these will be, coming out here pretty soon. And so just the basics of what conduit debt is, that's when a government will issue debt, but they're not the primary person that's going to be paying back that debt. Typically, we see a not-for-profit, could be a for-profit, either one is involved in that. And then, the debt obligation, they're not obligated to pay it, even though they're issuing it. So that's important to know. One more slide there, Zach. So the third party is not the issuer, it's the primarily obligated for payment of the amount. So that's the important part, that not-for-profit or another governmental entity it could be, or for-profit entity. And then it's really the issuer's commitment, is related to, what's the debt service payments? You're not obligated unless you have some type of guarantee in place, and that guarantee would only kick in if an event occurs that makes that guarantee applicable. So for the issuer government, so what do you do when you issue it? You don't book a liability. That was pretty standard practice, but they just wanted to clarify that and emphasize that to say, the issuer government does not have a liability. You could have a commitment. If you do have any type of commitment or potential liability in the future, you probably would want to disclose that, and you record it when more likely than not is the process you would go through to figure out when you actually record that on your books. Disclosure requirements, aggregate outstanding principal balance of that debt, any commitments as we talked about, and if you do wind up realizing the liability, which it's always an unfortunate situation, but does occur periodically, you have to provide the roll forward of those balances and cumulative payments have been made and expected recoveries, if anything. So public-private partnerships, I call this the original PPP, not that PPP that, that those other people had to deal with. So this is the original PPP. And as we all know, those PPP arrangements, are between, could be a government with another government or a non-governmental entity. And it's where you're using an asset and paying for that over time. So some PPPs could be a service concession arrangement. We also need to look at those as well to see if they meet the lease standard. And then, it's always important to remember, what is the term? How long is that term of non-cancelable right to use that asset with optional periods, which is a common theme. It's the same definition that's in 87 as well as what's in the subscription-based IT as well. So some accounting considerations for the transferor, is you continue to record that asset on your books, but you would record a receivable, the net present value of those installments, and then a corresponding deferred inflows, and that is what you're going to record. They're always looking for a spot to create another deferred inflow, and they did it here. And then that revenue is recognized over a systematic, rational method. Straight line usually sounds good to me, but you can pick a different method. And then some note disclosures as well for the transferor. The operator of of that asset. We'll record a liability for those installment payments out in the future at present value, and then record a right to use asset as well. And then you have a deferred outflow. If the operator creates or improves the assets in the future, they would record a deferred outflow and amortize that over time. So we do have some other guidance we've included in here as well. There was an implementation guide issued in late 2020, so the 2020-1 implementation guide. And it applies based on the various questions and when they're going to be applicable. There's 21 total questions. We do have, so as I note there, we're going to be going through a couple of these. We will not discuss the lease ones. We're going to save that for the separate class that we have on leases. So the first one is on financial reporting entity and physical dependency. As we were talking about before with GASB 84, is looking at who has control, and one of those areas is, well, how is the required contribution defined? If the primary government has the authority to change the required contribution, that would create physical dependency. If the primary government has no control of what that defined benefit pension plan sets, then it would not create financial dependency. Internal and external investment pools. So this could apply to some people. If you have an investment pool and the investment pool balances, the portion that the external portion of those, if you say someone else is invested in those, would be reported as an investment trust fund. The internal portion would be part of the government's own resources, and it's just recorded as you normally would on your governmental financial statements. Fiduciary activities, they talked a little bit in questions 4.4 and 4.5 about seized assets. So this is, typically, a court situation with the police where they seize assets for someone who had committed a crime. And the question came up, well, when does it change? At what point, can the government, use those assets? And it really makes logical sense. Is really, you can't make that determination until the court decides that basically the case is over and then the assets are forfeited. So they wanted to make that distinction, as well as in a school situation, what is considered administrative involvement in student clubs. That comes up a lot. And so they gave some additional examples, being limiting the purposes for which the monies can be spent, or requiring staff of the school system to monitor compliance could also be an indicator of administrative involvement. They clarified for asset retirement obligations that asbestos removal does not qualify as an asset retirement obligation and should be accounted for under the pollution remediation standards. Conduit debt, they just wanted to clarify that on conduit debt, to look at whether there's debt proceeds, if they're used to pay for bond issuance fees, or state insurer pays directly those amounts that are appropriated for local government, that they do not violate the criteria for a third-party obligor, and then that would blow up your conduit debt. So that's what they were trying to clarify there. This is a very rare situation, but you could have this where there's an option to purchase the capital asset under a conduit debt arrangement. You treat as if the issuer retains the title until the option exercises, which makes logical sense. You don't want to record something until it's actually happened. And then it gives guidance to say, what if you do take the option to exercise that? What does each party do to recording those transactions? So I'm going to turn it back over to Zach. We got about 20 minutes or so left, and we're going to start looking at some GASB projects that are out there in the future.
Thanks, James. And of course, the GASB always keeps us on our toes. There's plenty more out there. I've got a quick summary in here that there is a look at the note disclosure framework. We'll see what comes out of there. The three other big ones are all listed here as far as the recognition of certain elements on the financial statements, the reporting model, and then revenue and expense recognition. James will be touching on the new model improvements here shortly. A few other areas, compensated absences, how corrections of an error like prior period adjustments are handled. There is a renaming of the comprehensive annual financial report. in progress. That is looking to be renamed, basically flip the comprehensive and annual. So now the annual comprehensive financial report, or the ACFR. The pronunciation of the acronym was really the reason that that's being changed. So now it would be the ACFR under that change. And also looking at really uncertainties, contingencies, as well as risk areas. So plenty more still to come from the GASB. I'm sure we'll have plenty more new areas to touch on in this update next year. So before we get to the model, there is a look just first at looking at how elements are recognized in the financial statements, providing some clarification to some of those key areas. First and foremost, the GASB did look to look at the definitions over the current reporting model as far as the measurement focus and basis of accounting. Those generally largely unchanged, though there are still a few tweaks in there. There is a clarification to say that all outflows of resources and inflows shall be recognized when the event occurs, and then saying that when an item meets the definition of an element of the financial statements, and then also when it reflects qualitative characteristics to be able to report it. So again, conceptually, this doesn't change much, but there is some clarification to those definitions of what gets recorded and when. The big focus, as we'll talk to, and James will show a few examples, is the talk of short-term financial assets and liabilities. And the key here is on asset liability, still kind of what we would think about, but this new emphasis of short-term is all about the period from inception to conclusion being 1 year or less. In terms of what gets recognized, looking at the measurement focus, again, it's all about short-term inflows, outflows, the short-term assets, and other balance sheet components that would kind of really be your modified accrual focus, looking at that short-term basis, modified accrual as we call it now. The long-term items, similar to the way it is now, where like say a long-term debt payment is all about when those payments are legally due, that would rise to be recorded as a short-term item. Anything that is on a short-term basis normally, just like it generally is now, it would just be recorded once those transactions actually take place. The GASB does provide a hierarchy, they call it, of recognition to say when something would be recorded, to basically kind of focus it all on, does it meet the definition of an asset or liability, or a deferred inflow or outflow, or an outflow or inflow, to say that, okay, something must meet one of those criteria, or if not, then that probably should not be recognized in the financial statement. So again, just giving a little more, painting the full picture of what should be recorded and when. So with that, Janice, we'll hit polling question number 3 before we get to the real exciting stuff.
Here you go, guys. Who would you trust the most to come up with a good GASB pronouncement? The GASB board, James, or Zach? It's a tough one, I know. So we'll give you a few seconds to get everybody's votes in. Again, remember, we need all 3 questions answered for you to be able to get your CPE, as well as the survey we'll send at the end.
I think Zach or I would definitely, be more enjoyable and entertaining than the GASB board.
GASB board probably doesn't have dad jokes either, so.
I mean, maybe we could, throw a few dad jokes into the statement itself, just to really make sure,
see if someone
it's
actually
more
read it.
entertaining to read.
All right, 5 more seconds, guys. Get your votes in. And we're going to close out now. And let's go ahead and push the results.
Oh, the GASB board is winning,
They don't like that jokes.
Zach, we're going to have to work, but but if you combine our 2 scores, Zach, our percentage is 27-26, we won. So there we go.
Together we are preferred. So there is strength in teamwork. Makes the dream work.
All right. Was as some of you remember from last year, I do sit on the technical resource committee for the FGFOA, and we get the pleasure of responding for everyone that's in the FGFOA to these various different exposure drafts. And so this one and the other one Zach went over, of course, we spent a significant amount of time about a year or 2 ago when they first issued the invitation to comment, and now we get the exposure draft. So of course, I'll go start off right in the beginning because some of you may just zone out once I tell you when these are potentially. This is all exposure draft, so just remember that as I go through. This could change, probably not dramatically, but they could change. It's good. The implementation is going to be based on your revenues for your government. So it's annual revenues, and that's based off of government-wide, both your governmental and business type activities combined, but excludes extraordinary and special items. So if you're greater than 75 million, you're looking at years beginning after June of 2024, which is going to be your September 30th, 2025 year ends. And then if you're less than that, then it's going to be your year ends, 2026. So for some of you, you may be like, woohoo, I'm retiring 5 years. I'm already in drop. I'm out of here. For other ones, congratulations. You get to go through another reporting model change if you were around for GASB 34. So one of the changes they went through was management discussion and analysis. We've had that since GASB 34 came out. And you can see here some of, they're always trying to, any of you that are in the CAFR program know you probably get these comments as to don't be so boilerplate, reduce repetition, and give better analysis of what really happened year over year. And they basically have 5 specific sections which I want to go over for management discussion and analysis. One is the introduction section, and that's just an overview of the financial statements, looking at the relationships between the different types of information. You can go one more slide, Zach. And then financial summary is the condensed comparative information, just like we have now, the big tables comparing the statement of net position government-wide and the statement of activities. So really the same thing that we currently have. Looking at the detail analysis, this is really want to have us spend more time on the reasons for those changes, not just saying, hey, net position increased $1.2 million or 10%. They really want to say, well, why did it change? What were the conditions or the facts that a user would have no idea about that what caused that change? Were there policy changes? Is there economic effects? All those different types of things. Capital asset and long-term debt activities, similar to what we had before, so not a significant change there. The last section, section 5 in MD&A, is currently known facts and decisions. So re-emphasizing that to say, okay, what things have happened or going to happen subsequent to year end, even whether it's your budget, whether it's actions taken by the government for long-term debt, anything like that, new regulation to inform the reader. Another part of the exposure draft is unusual or infrequent items. So they're getting rid of extraordinary and special items, have a new category, and it's unusual or, that's the big term, or infrequent. So you get management control now is irrelevant, which that was a criteria for a special item. Short-term financial resource management focus and accrual basis of accounting. That's just a mouthful, but really what it's looking at is similar to what Zach was talking about, recognition based on short-term financial resources. And the concept right now is events as they occur from inception is the terminology to conclusion of less than 1 year. Long-term transactions are based on when they become due. Asset recognition for those short-term assets. And then we have the asset recognition, thinking about those, the difference between the current and those ones that are long-term. Long-term, you'll see that terminology over and over again when they come due. So that same thing when you look at the liability one. Liabilities arise from other long-term transaction events when the payments become due. In the short-term side, it's from the short-term events, you recognize them as they occur. One of the big changes is we will no longer have revenues on the governmental fund statements. So no more revenues. Probably won't miss saying other financing sources as much, but we no longer will call it revenues. It'll be called inflows of resources. And then what's that recognition? So it's looking at those inflows of resources for the current period. From a long-term basis, you recognize anything from, like, say, issuance of long-term debt would be a flow there. And just a reminder on those salary and fringe benefit payments, and here in Florida, the one that we usually have is state insurance premium taxes. That's pointing out that if you have anything on behalf of another government coming in, that gets recorded as a revenue, and going forward, we get inflow and outflow of resources. Outflows of resources. So we no longer have expenditures. So get rid of the term expenditures. So you'll be talking about expenses, either government-wide or outflows in your fund financial statements, or your governmental fund financial statements. So those outflows for for short-term transactions and other events, thinking about any of those outflows that right now are expenditures plus your long-term type activity, does exclude depreciation and amortization. So those are still government-wide only. Deferred inflows and outflows. So it's something just to just re-emphasize in there how those are assessed. Property taxes is probably the one we see the most, where you receive those collections in advance, or you record a receivable at the end of the year based off of that. And always remember, for deferred inflows and outflows, we are not allowed to create a deferred inflow and outflow. I cannot say something is a deferred inflow and outflow. Only GASB can say that. They've left that authority and honor to them. So how is it displayed? How are we going to look when we look at that statement of short-term financial resources flows? You're going to have activities, non-current activities, and they place standard, no longer have revenue funds. We'll have special resources funds. So you can kind of see on the next slide here kind of what the format will look like a little bit. You're going to have inflows. Zach, are you able to forward the slides? Oh, there it goes. There we go. Inflows of resources from current activities. You have the outflows. Then you'll come to net flows from current activities, net flows from non-current activities, and then you'll have unusual or infrequent that we talked about before. They did also make some changes in this standard to the proprietary funds, so that's your enterprise and internal service funds. What they did there is you're going to have operating revenues and expenses. Non-capital subsidies is a new category, and we'll go into what that definition is. In other words, it's really operating subsidies, and then non-operating revenues and expenses, which are capital subsidies received, revenues and expenses from financing, investment income, all that good stuff. So subsidies. So what is a subsidy under this new methodology? It's anything you get from another party, a third party, or it could be from another fund. It's an inflow that comes in to keep the rates lower. So I'm thinking about it in one of the governments we do. They have the local mass transit system, and that mass transit system gets an allocation each year from the general fund to kind of help support it. Well, that would be a non-capital subsidy that's going to be coming in to offset those. You also could have where one fund is providing a subsidy to someone else, that would also kick in. So here's the basic format of what the new statement for proprietary funds will look like, and this still uses the terminology revenues, expenses, changes in fund balance, and changes in net position. So you see there, but they added in that new category for non-capital subsidies, and now you have other non-operating revenues, where before, remember, we had non-operating revenues and expenses, and had down below further, you had capital contributions and grants and transfers. So now those are all up in other non-operating revenues and expenses. I know I got 5 more minutes, but I'm going to get to the examples here quickly. Component units, just know there's a little bit different stuff there. I'm going to skip that. Another big thing is budgetary comparison information. So previously in your MD&A, you had to talk about differences between your original and final budget and your final budget and actual results. Now that will be part of RSI. All budget schedules will be RSI. You're no longer allowed to put them as a statement. So that's a change that this standard would bring about. In the statistical section, there is a change if you do a statistical section, if you're in the CAFR program. And with there, it'd be only affected for business type activities if that's the only thing you're engaged in. And they're adding some additional items for you to disclose related to operating, non-capital subsidies, and the other non-operating revenues and expenses. The appendix of this exposure draft has some good information, specifically in Appendix C gives you some journal entry examples, as well as Appendix D gives you some financial notes and examples of the financial statements. So what does it look like? What does our new short-term financial resources balance sheet look like? So here's an example that they have. This is straight out of the exposure draft of what it looks like. So you can see there, you still have your assets, and it's a balance sheet approach. You still have liabilities and fund balance. You know, so very similar in that regard from a from a balance sheet perspective. The bigger change is on the short-term financial resources flow. And what you'll see there is, if you look about halfway down the page, you'll see for inflows from current activities, you'll see your transfers in, and that transfers out. So that's something you don't see right now. Right now, those are all in other financing sources and uses. And this is just half of the statement. So the next slide, you'll see the bottom half of this new format, and you'll see transfers in and out again. And those are from non-current activities. So something we'll have to think about in our chart of accounts and how we're keeping track of our transfers is to delineate between, we'll need to set up new accounts to say what's a transfer in that's related to current and non-current activities. And then you see also there the unusual and frequent items. I think I'm just about good on time, but do want to remind everybody of our next webinar, which is going to be coming up on May 19th on cybersecurity, remote access, and safe computing. Janice, you want to take it over?
That's correct. Yeah, that's correct. Yes, we've got our next webinar, cybersecurity, remote access, and safe computing. We don't have any other questions, but just to let you all know, because several of you asked about it, we will be sending the slide deck in the coming days on a follow-up email. So rest assured, you will have a copy of these slides. I know we had to kind of fly through last one. Sorry about that. If you think of questions after we get offline, please feel free to contact Zach and James. Pretty shortly, their contact information will come up on the screen. There it is. They're more than happy to help. And finally, we're going to have the rest of our CPE series topics for the year come up on your screen. You can click on those links or go directly to the registration page, or you can go to our website and there's a blog post where you can sign up as well. Below that, you'll see the link to complete the evaluation we talked about to get your CPE credits. And again, that is required to get those credits. This link will also be emailed to you. So it's been our pleasure to bring this information to you today. So thank you, Zach and James, and everyone have a great rest of the day, and please stay safe and healthy. Bye-bye.